Welcome to BloombergQuint. You're watching IPO Adda, and the company in focus today is Anand Rathi Wealth IPO. The company is coming out with an IPO of 660 crores, which is primarily an offer for sale at a price band of 530 to 550, and the IPO opens on December 2nd. Joining me today is Amit Rathi, who is a non-executive director at Anand Rathi Wealth, and Feroze Azeez, who is a deputy CEO at the company. Gentlemen, welcome to BloombergQuint. Let me start off by saying this is the second time you're trying to come to the IPO. In 2018, you had filed for an IPO and then you withdrew it because of market conditions. But at that point in time, you were trying to raise some fresh issues as well. This time it's entirely over. Why is that?
So I think, Sajid, over a period of time, the capital that we were trying to raise at that time was more for capex needs, and it was a small amount of primary. It was only about 100 crores. And I think if you look at the performance over the last 2 years, the company has generated enough cash flow internally, and we've got other sourcing sort of places from maybe to source capital. So we didn't need to issue fresh capital at that point. Even in 2018, the portion of primary was very, very small. So it's largely, this is a business that generates a lot of free cash flow and doesn't really need to raise primary capital.
Mm-hmm. I was looking at your share price history, and you had made a preferential allotment to Feroze at an ex bonus price of around 274, if I'm not wrong. And you are coming at nearly double the price in the IPO. Why is that, and how do you justify this valuation within a year?
So, Sanjay, there are two aspects to look at this, and I think one, of course, is Feroze is a key management person for us. He's one of the core driving force behind the business. Second, I think when you talk about this was done in last year, in April, May, June. The allotment actually happened in July. The board resolution was slightly a few months earlier. And since then, if you look at the market itself, right, over the last 18 months, markets and valuations themselves have changed dramatically. So I think it wouldn't be a fair comparison to compare a data point of 18 months old when the index, the Sensex was 7,500, 8,000, 9,000 to today's market.
Okay, so tell me how your fundamentals have changed in that 18-month period, Feroze.
Hi, Sanjit. Of course, from a fundamental standpoint, COVID year was a challenge for most of the businesses. We have done fairly well in the first 5 months of this year, which is the right representation of our business in dynamics. Point one. Point two, I think the robustness with our AUM growth, which has happened over the last 18 months, is phenomenal. So I think fundamentals have gone really strong on all key parameters.
Okay. Just wanted to get a clarification. You came out with a 5-month period and which has no comparable to last year. Why not the full half-year period numbers? Because you will have to come out with these numbers within the next few weeks as soon as you list. It could have been better if you had brought in the 6 months period, so that at least you have an idea of how the performance was for the half year and the comparative, or how the comparative was last year.
So, Sajid, this is really, we go by the advice of the bankers, and from a timing issue, when you file with SEBI and the approval process and the backlog, and we know it's been a busy calendar in India in terms of IPO activity, right? And the idea was to not be at the back end of the pipeline, but do it in a timely fashion. And I think our business, if you go back, our business, of course, 21 was an exceptional year from a COVID perspective. But if you look at the long range performance, in the last 3 years, our AUM has grown 22%, and our business is primarily linked to our revenues, and profitability is primarily linked to our AUM growth habits. And over cycles, I think that's a number that we wish to track. And I think that's a good predictor of where our business could be in the future. So yes, of course, people would love to know 6-month results or even, more recent results. But given, the regulatory requirement, what we could do at that point was give the latest data point which we had, which we were able to audit in the timely fashion and sort of share. But I think, it's a business which is not a very volatile business generally. And, investors who come into our company are essentially guys who need to look at a long-term horizon. And let's say over a period of over cycle, what's the macro story in the wealth business in India? What's the number of, dollar millionaires that are growing? What's the kind of wealth creation that's happening? Where is the value add that this company can provide? And can these guys track that growth, right? So if you see, most data projections are talking about a 15-20% growth rate in number of millionaires over the next 5 years. That's been the historical growth rate as well. Within that, financial savings, within that, the share of investing, vehicles like mutual funds, and those are, our primary vehicles through which we actually advise clients. So if we can track that, can a business grow 15-20% over cycles? That's the objective. It's not about how a year or 6 months or 1 month will move the needle per se. Valid point. People want as recent a number as possible, but this is really a long-term secular story that people have to sort of take a call on.
Feroze, I'm looking at your numbers for the 5-month period, and it's quite an impressive performance, especially on the EBITDA front. 73 or 74 crores versus 69.8 crores for the whole of last financial year. Where is this growth coming in from? Which segments are driving this growth? Because if you look at the revenue run rate, you will almost double. And maybe more than 40-50% growth in the top line, which we are looking at if you analyze it for FY22. So if you can give me a color of where the growth is coming from, which segments it is coming from, and which are the bigger margin businesses which is driving this.
Sanjit, I think there are several legs of growth in our business. To be precise, there are about 4 legs of growth. One of them is the AUM growth, which is because of fresh monies you bring along and the growth in the portfolios. We've positioned the portfolios to grow at a reasonably good rate, which is double digit, and markets have done well. So that contributed a certain portion of the growth. The second leg of growth, which we focus on, is the capacity utilization of the current RMs. There is a huge capacity utilization possible. The number of clients a person can manage still has another 40% to grow. So last year was one of our best years from a client acquisition standpoint, and that momentum continued. If you get fresh monies, that results in revenue growth. The third leg of growth is newer RMs who come in, and that's also contributed in the first 5 months. And lastly, clients, when they begin, they don't begin with all their money. There's some credibility which needs to be created over a period of time, penetration. All these 4 legs of growth have contributed owing to the efforts done in the last few years.
What is the kind of average portfolio size per client you have? Because you have 6,564 clients at the end of August.
So it's about 4.5 crores roughly, Sajid.
Okay. So and that average size is increasing on a yearly basis, or how is it performed? If I can get a picture of how much more incremental money you're handling per client.
So Sajid, it's really a function of 2 aspects here. One is the target client segment. So for us, really the target client segment is people with investable surplus of 5 crores to 50 crores. That's a target client segment. And like Feroze mentioned, when clients come into the system, they might start with a smaller amount, but over a period of time, they scale up. So today, about 50% of our assets come from this client segment. Then we also have about 15-16% of our customers who are 50 crores plus. Most of these customers were smaller with us when they started, but then they had some liquidity event where they came into monies, and they've stayed with us in their journey. And the other driver for where the average is the number of RMs in our system. What proportion of RMs are new and old? Because the newer RMs will have newer customers who will also age with them. So from our perspective, what we are not tracking per se is the average size of the customer, because the target segment for us is very well defined. What we're looking at is, can we control the RM vintage and ensure that RMs who come into the system and become successful actually stay with us? Because after year 3, after year 5, these RMs really start contributing towards our AUM growth and revenue growth. And that's the effort, and within them, the clients that they manage also start to grow in the system.
So how do you manage this RM, churn? I'm sure the industry is growing in a very fast rate, and there is a huge churn in RM as well. How do you, and when they move out, they also take out your clients and they move out to others as well. So how do you manage the churn, and what is the kind of churn you have for RM, Azeez?
Yeah. Sanjit, I think people is a very important part of this business. So we have tried to make sure that there's consistency in their remuneration, and the cultural aspect which we have created, which is very unique. For the lack of time, we have created a platform which is entrepreneurial in nature. All the attributes of an entrepreneur are delivered in the platform, more or less. If not all, 80-90% of entrepreneurial attributes are delivered. That's why we've seen significantly lower attrition rates, and we've been ranked great places to work from 2017 to 21.2. Point 3 is that how do clients move out if there is attrition? Regret attrition. The answer is, if the clients have spent 3, 4, 5 years in the system they are married to the process significantly. So the attrition of assets in case in an event where a relationship manager moves on is not very high. So substantive portions of the assets stay back in the platform.
Okay. Feroze, I just want to get an idea of the EBITDA margin that you're working on, right? In FY21, it was around 26.3%, and in the 5-month period, it's 44.2. Now, that's quite high as compared to the industry standard, because the only competitor you have is the IIFL Wealth, and they are working on 32 to 35% margins. Is this an aberration or a financial diet which is leading to this bigger EBITDA margin, or is it a normalized margin which will continue going forward?
So from an EBITDA margin standpoint, last year would not be a fair comparison.
Okay, the year before that it was 32.3%.
Okay, so as efficiencies build in, economies of scale come in, and operating leverage comes in, I think 40% plus EBITDA margin has been our aspiration. Will we expand different verticals to make our business further robust? The answer is a yes. So 43, 44 could be a marginal stretch, but 40, 41 is our aspiration, and that in a well-oiled machinery which has been operating for several years seems very, very likely.
So if I may add,
yeah, Amit.
Apologies, Sajid, if I may add 2 points here. So one of the things to consider is also that our yield on assets is amongst the highest in the industry. I think actually there's no apples to apples comparison, unfortunately, in the listed space. IIFL, in my sense, caters to a slightly different client segment and also has a large balance sheet linked play. But our yields on assets, if you compare across the industry, are amongst the highest. Number one. Number two is, in our business, there's a fair degree of operating leverage. So as RM vintage grows to 3 years and goes to 5 years, because that's when RM start becoming profitable. And as your mix of the RM community that you have as of a date, the more it is of higher vintage, the higher operating margins will continue. And that's, so if you do it in the last 3, 4, 5 years, we've added significantly to RM pool. And as they have matured to a 3-year plus vintage and a 5-year plus vintage, it has started to reflect in our operating margins. And that's going to be the key driver. So, and I think, as Feroze mentioned, aspirationally, I think that 40-45% range is something that we think this business can continue to deliver. And
do you think that the RM maturity beyond 3 years, if it's going to bring in a lot of leverage in terms of margins for you, what percentage of your total RM force, which is maybe about 233, if I'm not wrong, it is over and above 3 years?
So 152 out of the 233 have finished the 3-year period, and you were right that this business starts giving you that hockey stick at an RM level after you finish a period. So 81 of them were below 3 years as of March 31st, and 152 of them had finished 3-year period. And we are reasonably excited of having these 81 come into the more profitable zone of having spent time. And what's very important here to notice is we have this principle which we've been working for the last 5-6 years of internal hires of RMs. So we have we are in the process of training about 228 account managers who currently support the 233 relationship managers, who are bright young professionals who are future RMs. So that's one more thing which we are really excited about in the queue for them to join the RM force.
If that is the case, that if you're promoting internal talent to the RM stage, then why should it take 3 years for you to get profitable at the RM thing? Means the people are already in your in your organization already working in. Just to understand.
Not a very valid question. I think the first 2-3 years is really for them to understand the business and the advisory process completely. It's more a reskilling and education in terms of how wealth management is delivered, what are the key principles around it, and they understand nuances of client management. But when you actually start managing clients, for each person, the biggest source of acquisition in this business is references. It's very difficult to just merely cold call people because there's a huge trust factor around which, and that creates a barrier to entry for almost everybody in this business. That the trust factor that people are willing to entrust crores of their personal wealth to an institution and to an RM. And for an RM, in the first year, 2 years, he has that core set of 10 customers, 20 customers. It's when you've got that 20, 25 customers is when incremental growth starts to kick in. So, right, the journey of an account manager as an RM actually starts only when you become an RM. And the core set of customers that they acquire, have they got a nucleus enough of customers that will sort of allow them to carry on this path? That journey doesn't change. But what the advantage for us is that it does two things for us. One is we get people who are completely trained into the Anand Rathi way of delivering wealth solutions. Number two, it allows us to potentially create a usually very scalable organization where we're not dependent on lateral hiring to drive our future growth. This is like our own cadre, which is trained in the Anand Rathi way of delivering the solution to customers.
So, I was looking at your mix. Mutual distribution gets you around 33 to 34% of your revenues. The remaining comes from sale of structured products. How secure are these structured products, Amit? Because we have seen in the past that in the NSCL case, a lot of clients got burned because of structural products, which was an initial spot which was being sold. So, what is the kind of new ring fencing that you have done for clients?
So Sajid, I think the NSCL is more an exceptional case, which is not so much a wealth management product. It is more a trading, but I think just coming back to
the structured product, basically.
No, it was not structured products. So structured products from market-linked debentures globally are pretty much the predominant vehicle in the wealth management business globally. If you look at markets around the world, alongside mutual funds, equity-linked notes or market-linked notes are the primary form products that are
part of customer
portfolio. That's one aspect. The second aspect is the key around everything is the design, right? How do you design products that actually add value to the customer's portfolio? Because you could do a design in isolation and build a product. Our customers are people who are seeking long-term returns of 12, 13, 14%, don't want to take on too much risk. They have 5-10-year horizons. And therefore, the products that fit into their portfolios are also products that have a reasonably high probability of delivering the maximum returns. They are not too greedy of saying we want structured products to create exceptional returns for us. So structured products really fit somewhere between debt and equity for most customers. And that is something there's been an 8-9 year track record around that, where customers have seen performance over a period of time. So the key around this is design, and I think that's a strength that we bring to the table of how we actually design this in the context of the overall client portfolio.
Feroze, I'm running out of time, but I have a couple of questions for you. One on the operations of the company. One, last year, Amit said a while back that this is a free cash flow generating business, but still you had a working capital requirement, as a result of which your net operating cash flow was negative in FY21. Just want to understand, where is this working capital requirement comes in from? How do you manage it if you have a free cash flow company?
So what happens is, Sanjit, last year you would have traded in several MLDs. So MLDs, you have a cash flow mismatch sometimes. So you need working capital because you buy and sell securities. That's one portion of our business. So if you look at the free cash flow on a year-to-year basis, it is a cash generating business because most of the expense is human capital and trade commissions and your profits from trading of securities. So capital need is very short-term in nature. Working capital needs are very short-term because you buy securities and sell securities to match the cash flows when you will need working capital needs.
So basically, you buy the structured products and then sell it to the people, or when you get the client, he gives you money and then you look at the structured product.
So, so there could be some clients where you would get an advance for the money for the security. Sometimes it could be the security reaches you a day or a couple of days.
And what has been the traditional thing? Because 2021 was a aberration because of the COVID. There were people taking more time to decisions. I can understand that part of it. But over the last 3 to 4 years, has that been the tendency?
No. Sajid, the cash flows are identically matched generally, and 99% of the cases, the money reaches us before the security gets delivered. So cash flow needs in the future, to my mind, are negligible, if not nil.
And MLDs as an instrument, do you see any risk coming in? Because we certainly saw Reliance Capital having issues, and they also came out with 4,000 odd crores of MLDs in September, if I'm not wrong. And people, 2 institutions, and some mutual funds, and that's creating an issue with respect to the entire MLDs and the risk which is associated with MLDs if a company goes down the IBC route.
Sajid, we have a very strong internal due diligence team before we choose an issuer, whose MLDs we are okay to distribute. In fact, we stopped issuance of a few of the names who ran into trouble much before this happened, because MLDs, it's very critical to see the robustness of the balance sheet. And we have a 54-55 member research team internally, out of which a substantive portion is dedicated to the MLD research, to look at each constituent of the balance sheet to understand if there is any credit risk at all. And in India, 2006 is when one of the first MLDs was issued in July 2006. There have been no instances other than the one you mentioned where there has been any delay in payment, and most MLDs issuers have also honored premature withdrawals which they were not obligated to. So it's one of the strongest track record in the form of any other debenture issue.
Amit, the final question to you as a market, but how do you see the market panning out? Do you see the volatility continuing? We're seeing Omicron coming in and getting some kind of volatility in the market globally. Do you see that disrupting the entire flow which is now coming into the Indian market?
So honestly, Sajid, I'll be disappointing you because, wearing the wealth management hat, usually we are talking to clients over 5-year, 10-year horizons, and it's been a luxury that we don't have to focus on what's going to happen in the next 3 months, 6 months. Yes, these things will happen. You will have a third wave, fourth wave, fifth wave. But I think if you go back and look at, and really a conversation with clients is look at the macro fundamentals, at the macroeconomic level, at the corporate level, look at the financial savings pattern and how India and financial literacy in India is sort of going across the, client curve. I think, we are not worried at this point of time. I think, yes, these events will happen. Markets can move 5, 10, 15%. But honestly, I mean, we're sitting in a good place where our customers have 10-year horizons, and therefore we don't need to be bothered as much like a lot of you in the other side in the studio trying to predict where markets will be in the next few weeks and months.
Gentlemen, it's been a pleasure talking to you. Thank you very much for joining us today. The Anand Rathi Wealth IPO opens on December 2nd with the price band of 530-550, OFS of 660 crores, valuing the company at nearly 2,200-300 crores odd. So thank you very much for joining us today on IPO Adda.
Thank you, Sajid. Pleasure.
Thank you.